Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everybody. Today is Monday, June 2nd, 2025. This is our State of the Market webinar. This webinar, we look at the big indexes and the big sectors. On Thursday, we do market trends, and then we look at more kind of nuanced stories and individual trends, sectors, industries, things like that at a more kind of finer level, more focused level. But on Mondays, we look at the big indexes and the big sectors. So those are some disclosures I just showed you. I'm going to also show you here some standardized returns of the ETFs that we might be talking about. We will be talking about some of these, and these are the standardized returns. Let me also share with you some important disclosures in the chat. It's great to be with everyone. Now, also, you might want to go to tradestation.com. And you'll see at the bottom, toward the bottom of the page, you start up at the top, you scroll down, you'll see a story here, stocks get stuck as trade worries return. Now, this article outlines a lot of the main points we're going to be talking about today. These are the big things. You look at the overall kind of state of the market conditions, especially this section here called charting the market. So, all right, now, we're just kind of drifting in a range here, not surprisingly. Look at the S&P, real quick, daily chart of the S&P here. I'm going to get back to just kind of in this range for a while now, and we're going to get back to this. But I want to just mention that this range, if you look at our articles, we do our market trends on Thursdays, and if you actually look back to our market trends that we did back on May 16th, we identified this range. It was our market trends about healthcare, but we basically identified this range, and it's remained in effect. Then on the market trends on May 22nd, we talked about the fact that we could be entering a new phase of sell America, the so-called sell America trade, weak dollar, strong gold, weak treasuries, that whole thing seemed to be starting another sort of wave potentially. We identify that, and it is kind of playing out. So don't forget to watch our webinars on both Mondays and Thursdays. It allows us to kind of talk about what's happening in the overall market twice a week, which can be kind of helpful. So I think right now it's important to realize that this range remains in effect. As I quickly look at some of the important things happening here, I would say the market feels strongly both ways. You can kind of be optimistic that things are going to get better in terms of the trade situation, and there's also reason to be pessimistic, and those reasons are potentially growing when you look at the evidence. I think right now we're sitting and waiting and watching. Trump is reportedly meeting with President Xi of China. We're also waiting on the payrolls data this week. Next week we have CPI, all these different things happening. And I think Powell might actually be speaking today as a potential catalyst. But I think overall, even then, we kind of know what the Fed has to say right now. So I want to mention that this to me looks like a moment in history back in 2023. In May of 23, we were waiting for the debt ceiling to be raised. And this is a chart, a chart image I have it. Now look at this period of time when we basically just hugged right along the 10-day simple moving average. The 21-day exponential was along there as well. But you can see that we went up and we were stuck range bound. This is coming out of the bear market of 22, early 23. We had initial rally. We crashed when the whole thing with the Silicon Valley Bank happened. Then we rallied back and we sat and we consolidated until the debt ceiling was raised, and then we went on a rally. So basically, that was 34 bars. Now, if we look over here, 34 sessions, and we look over here on the daily chart, you can actually see that if we were to look at a similar range, that would basically project us through the end of June. So right now we're, I don't know, maybe not as many bars into it. I just drew this to show 34 bars. So we're, at this point, if we go into a period like this, now what's interesting about this earlier period of time is that we also kind of got above the 50-day and we sat, and it's not exactly the same, but it was a period when there had been a decline. Then we turned higher, and we had to basically wait and see and try and turn the longer term moving averages higher. We had to get the 50-day rising again. We had to get the 200-day rising again. And at this moment, when you look at the market overall, the 200's rising, but the 50's just turning up. We've really extended over it. So it's not an identical scenario, but it is a similar situation here where we are potentially in a range that was identified, some time ago now, back in the middle of May. That range was evident. And now we're in a period where we had this strong bullish thrust, and now it seems to be a period of neutrality, and we're waiting to see how does it end up. Back then, it was, will they, blow up the debt ceiling, or will they succeed in all these different issues? Is it, kind of a different political situation then? But that was the concern now, and I think now the concern is it's still a political concern, but this time it has more to do with things like trade and stuff like that. All right, so I think right now in many ways people kind of have to just look and just kind of decide what do you kind of which of these things you see playing out. And I have to say that from my perspective, we might be more in a situation now of this being a lower long-term high within the context of an emerging kind of potentially longer term period of weakness. And the reason I say that is because we have seen some real kind of degradation of earnings. And I think also the bigger thing is that we are getting into a spot here where the economic data is not as good. So one thing I just noticed overall was the fact that the sector mix is getting less positive. We're seeing consumer staples, utilities perform well. We're seeing the cyclicals not as strong. And I think that's something we have to just kind of, there are some potential here that are pointing in that direction, more kind of economic weakness. Now, I want to just point this out. This is not to say this is what will happen, but this is back to the 1930s. And if you look, this was the initial crash in 1929. The market rebounded, and then it began this long downtrend. Now, it did a 50% retracement, and this time we've gone above that. But if we are in a period here of a longer term shift away from, U.S. assets, it wouldn't look exactly like this. But the thing to be looking for would be, do we form a lower long-term high and then form some kind of distribution? And I think that's really the question, because I think it's important to realize that, the kind of American exceptionalism, whatever you want to call it, we have been in a monster outperformance of U.S. equities over the rest of the world for a very long time. Like for a decade, pretty much 15 years, going back to around 2011. And so there's reason to think that it will be a period of distribution that could last a while. I mean, I just point that out as something that is a possibility, but at the same time, there's a lot of negativity out there. So, I think with trading, you have to look at the different possibilities that are out there and then kind of see which one you get confirmation of. And right now, in the middle of the range, we don't have confirmation of much of anything. So that's the main thing. Now, I did want to mention just very quickly, if you look overall, I think of the economic data. What is interesting to me, and a lot of this is outlined in the article that we actually have up there, but I think it's important to realize right now that we see continuing jobless claims are now kind of trending up to where they were, and they're just trending higher. Initial jobless claims, not as high, but they are still moving to the upside. And I think the thing is that there's a lot of evidence here that once layoffs begin, they could actually cascade. There's a lot of situations of employers not wanting to lay people off immediately coming out of COVID. Well, it was hard to hire people coming out of COVID and all of that, but we've seen hours worked really decline. And we've also seen hiring really stall. And those things suggest right now that there is weakness in the labor market that hasn't broken. But if it does start to break, I think also people have to realize the political environment, layoffs would likely cause political, reaction. At a certain point in time, companies will do it. And I think it actually creates a scenario here where layoffs are going to be delayed, and then they could cascade. And not there yet, but I think also when you look out, these are things that now are problems or potential problems and weakness for the economy overall. We also have the issue of student loan defaults and things like that. So the economic data today, these PMIs from Institute for Supply Management and S&P Global, both of them showed higher prices and delivery delays in terms of industrial production. And these are actually things that make the indexes higher. Those are considered positives when it takes longer to do deliveries and when prices goes up, because in a normal environment, those things mean stronger demand and companies are going to have to hire and invest to keep up. But we don't actually see the production or the jobs going up very sharply in any of these indexes. So these are kind of false positives that are kind of pointing for a situation here of there's been a surge of activity kind of because of getting ahead of tariffs. S&P Global cited record inventory builds in the manufacturing sector, and the orders, we're not seeing export orders go up. So overall, there are reasons to look at this data as being something that is kind of also, pointing in a negative direction. So it was interesting for me. I looked at FactSet. They do this kind of they call bottom up analysis. They did it back on May 23rd, and they said the S&P could go to like 65.32. But that was based on their calculations. It wasn't FactSet's prediction. What they did was they basically took all the price targets out there of all the analysts they cover, and then they basically said, if we put them all and assume they're all true, where does the S&P go? They said 65.32, which would obviously be upside from here. However, when you dig into what they say, they also said that energy and healthcare have the most upside. As we're going to get to the weekly chart of all these things, as we always do on State of the Market, the weekly charts of those actual sectors. That might not actually be the strongest sort of expectation. I thought it was interesting that Richard Bernstein talks about a peaking of the profit cycle. And I also think it's important to realize you look at the potential for the economy weakening, you look at tariffs, what they mean for margins, and then you also throw in what NVIDIA said about losing market share, losing business in China. You just can look at this maybe, and it might not. I mean, we could be at a spot here where maybe Richard Bernstein is right, and maybe if we're at a spot here with things like yields moving higher and things like that, if we are at a peak of the profit cycle, the S&P trading around 21 times earnings or something, that is also something that I think we have to kind of bear in mind as to see, does this become a long-term lower high? High, lower high. Is that what happens here on this daily chart of the S&P 500? And we are going to get into treasury yields, and I think that is an important thing because I'm sorry. Treasury yields is a thing coming up where in this bill going through Congress, whatever you want to call it, there's something called Section 899 that potentially could be a negative that could hurt foreign demand for treasuries. That is completely new, a completely new thing out of left field. And to me, that's one of the kind of negative, concerning things, is because when a trend emerges, something happens, but then it keeps getting confirmed. And I think that's kind of, if we are in a true Sell America multi-year trend here, then these things play out. I believe in trends as a kind of someone who watches the markets, and it's one of those things when you buy a stock for one good reason, and then another good thing pops up, and when things are good, they go from good to better. More positives keep kicking that trend along, and that's the way trends tend to work. But the thing is that if you look at the way some of the news is flowing, we have big treasury deficits. That's a negative for treasuries. Fiscal deficits, which more treasury supply. We have the thing with tariffs, which has hurt demand for treasuries. Now we also see this potential thing in the tax code that could hurt foreign demand for treasuries. So this looks similar. It's the opposite of what's been happening with something for years like NVIDIA, where first they were good in video games, and then they were good in data center, and then they were good in AI, and it's one good thing after another. But now it's kind of, when you look at the American situation, it's kind of potentially one bad thing after another. And this is how trends happen. It's just the mechanics of market trends. There is a fundamental side to it. So those are the main things. But I also want to point out that despite these things building, if you roll out into the future, June 11th, we get CPI. There's still positives potentially in the CPI, with energy coming down and signs of housing prices coming down. So I still want to point out that in that there is that kind of flickering light that you can look out to beyond just a trade thing, but there is this flickering light of this kind of Goldilocks, disinflationary narrative that people aren't focused on it, but it is out there. And I think we just have to remember that it's there. And I just want to remind people that June 11th has the CPI report. All right, so let's take a look now at our weekly charts. I think I showed the standardized returns. I showed this blog post. All right, let me just make sure I'm not missing anything. This one, I'm going to just close the things that I don't need anymore. All right, we start with the weekly chart of the S&P. This is our range on the weekly, and we had talked about this. It basically goes back to the last Friday of last year. You know what? I drew it in a different spot. There, basically, the top of the range was also this last Friday, which was this level here. It was the week begun June 23rd, December 23rd. Anyway, this is the high. This is the low of our range. It's interesting. You have an outside week, inside. So here it is. It's just kind of forming and squeezing. And this is not confirmed to be bearish. I mean, could be something that does settle into a range. It sits and waits for a while until we know. And I want to just point out that this is now just a range, and it's going to be, it's frustrating. Ranges are annoying very often for traders and for people who want to follow trends, to get stuck in a range. But it is what it is, and that's really what the chart is showing us here. looking over on the daily chart. Now I've noticed I'm a fan of the 10-day simple moving average, and I've noticed that when you get down and you start kind of touching that 10-day simple moving average a lot, it's an indicator I use, others don't. But I think it's interesting now to kind of see, when this can mark the end of an uptrend. It gets up and it kind of sits at that 10-day like here, and then you get the pullbacks when you kind of see these different moments in time when you're above the 10-day and then you start getting in it, and then you have weakness. So for me, this is a potential reversal. Although I think right now we're in this spot when it is going to be binary based on the geopolitical trade situation, and is an inside day. So this is just classic range behavior here. We are holding above the 200-day moving average. If you look at things like MACD, they're showing signs of momentum fading. But when I look at this overall and I look at the geopolitical thing, I also look at, don't forget, we do still have this thing in Congress, so we don't know how it's going to play out. This very well could be basically a mirror or a copy paste or a repetition of what we saw that other chart I showed you of June 2023, when it was just a sideways movement waiting for the debt ceiling to get raised. This could simply be this really just stuck June and then some kind of resolution. So this is what the chart's telling us. All right, now look at the Qs. It's a very similar sort of environment. Through the day, I'm sorry, the weekly one, the weekly of the Qs. Now, this is also something where we basically have an inside week here, kind of just today, kind of forming. And from my view, again, this is just kind of meaningless drifting. When you're in this kind of environment, you can see things just get bullish, and then in the last 10 minutes of trading, it can just fall out. It just kind of drifts around the ranges, and that's essentially what we have here. So from my perspective on the weekly, this is not giving us much of anything. It does have the potential on good news, though, to run back up to to run back up to the highs. And I think right now, when we look at things overall, the Qs are in a better environment, and the things like the Russell is now the area of kind of weakness. So the Dow is is in a similar situation. The Dow looks kind of like the Russell, which we're going to get to in a second. But basically, we do have these kind of these highs, and the high from late March where we seem to be kind of stuck. And I think also we have to wait and see. This could be a lower weekly high on a long-term chart, and to really see what happens. And so I think we have to kind of see how this plays out. But from my view here, this is squeezing, and it's less bullish. It's giving less kind of clear bullish signals, and we're in an environment now where yields have been moving higher, and that's the focus. And that is something that is not as good for something like the Dow. It's more of a value focused thing, and that's not as good for this environment of yields moving higher, and also the weaker economic data. If you look at some of these charts, I was looking a lot at like Caterpillar. I mean, it really looks kind of challenged. I mean, some of these names, it's kind of cyclical names, these industrials, as we're going to get to, have run a lot. And so for me, that's actually something that is something of a risk here. All right, so that was the Dow. If we go now to the Russell, RUT, it's also interesting. Look at how the S&P on the weekly chart here is an inside week. But now look at the Russell. It's not an inside week. It made a lower low than last week. So again, Russell is kind of showing us again, it's the kind of survival of the fittest, all that sort of thing. It's not, it's the weakest, kind of shoot the weak, the weakest ones will be the ones that get hit the hard, will be the ones that really struggle. And it's interesting to see here that the weakness of the Russell is reasserting itself, which means if we start to get some break to the downside, overall market, if we see yields move higher, this could really deliver to the downside. And I think this is something I'm kind of watching to see if it gives an opportunity to step in and drop the hammer on it. This could be something I think that, because if you look at it, it's also stuck at that level from March. It's lagging, and it's interesting to look at the Qs. Last week getting above their highs, from the mid-May week, getting above the highs. The Russell, not so much. And this is kind of what something that is relative, has weakness on the relative strength overall showing us. So that's the Russell here, and that's what I'm watching for. Now, TNX remains perhaps the most important thing. I think that many times you kind of have to decide what is the most important market, what is the most important chart to look at. And, I've been saying, for a while here that it is the 10-year treasury yield. I think if you went back 5 years ago, the most important chart to look at was the NASDAQ, but now it very well could be treasury yields. So I think if we look at this here, we basically see, there's a lot of things on this chart. But what's interesting to me is we talked about the last time we were doing this webinar, we said that we saw potential for a probe up to 465 and then a stall. And then since then, basically the trade war has resumed. It's come back. All this stuff with tariffs on steel and more tit for tat with China. All these sort of things that kind of point to that direction of less demand for treasuries. Most people have never thought about treasuries being something that have demand the way other assets do. It's always based on things like what's the inflation rate and what's GDP, and you put in a number and it spits out. That's where treasury yields should be. But now treasury yields are being viewed as an actual asset with actual supply and demand. And the fact is, if you burn some of your buyers, like Chinese, like Chinese, the Chinese central bank or something like that, and you say we don't want to buy your stuff, then they're going to say we don't want to buy your stuff, and that's essentially, I think, what is reasserting itself. And so the fact is, this was the level that we identified, and it has actually proven to be a level where it was going to peak. This range between 460 and 465. But the fact is that now there's reason to think that it might be wanting to continue to push higher. To me, the key thing here is that we have this high basing pattern, and I still believe that the level of 432 going all the way back to June 2008, which I'm not going to show here in this chart, but if you go back to June 2008, it was the high amid the financial crisis. We were basically stuck under that level for more than a decade, and now we've been fighting our way back through it. From my view here, the fact that we're holding above it is potentially pointing to more upside in the 10-year here. So BlackRock today put out a note basically saying that this ongoing budget bill in Congress is hurting global demand for treasuries. People are saying like the U.S.'s deficit is too big. Overall, global investors are rethinking their desire to own treasuries, or at least in the size that they have. Now, it's also important to realize, we don't talk about this one as much, but TYX, the 5-year yield, is pushing back today. It went back and actually hit 5% again. It hit 5% 2 weeks ago, and it freaked people out. But again, you look at something like this. This is, to me, an interesting one. The thing I find most interesting about the 5-year is, if you look here, it made basically higher lows coming out in August of 2020. And if you look at something like the 10-year, well, it's harder to show in this chart. But if you look at the 2 years, the 2-year yield and the shorter term yields made lower lows, and the 10-year, basically the 30-year really did show. It was the first chart to clearly show that the downtrend in treasuries had ended. And so what's interesting to me is to see this kind of pushing to those highs. I think this is actually also kind of consistent with the 10-year moving higher. I don't look at the 30-year all that much, so I don't want to get too much into it. But the point is just that if it's hitting 5 and getting over 5, then that is also something that has that potential to pull up TNX. And then the question simply becomes, what does that do to the Russell? So I still think that right now the Russell is kind of the thing that people might want to be looking at, with the potential to, at a point in time, to be more negative on it. So now the dollar index, the market is pushing kind of higher here intraday. I'm not sure exactly what's going on, if there's any kind of news. This is another one that's important to me here. That the dollar index here is essentially trying to hang on to this level from it was July of 2023, and we're not getting much bounce here. So from my perspective here, this remains an important thing to watch, with the potential for some kind of extension to the downside here. And I think this remains a pretty important chart. And I think that the dollar index, and then something like gold. We don't talk about gold in this webinar. It's not something that I follow as methodically, but it's important to realize here. I think that with treasury yields moving higher and the dollar index moving lower, these things are consistent with that kind of overall sell America theme, and so this seems to be kind of not showing any sign of that theme ending. The fact that we are basically pushing under this low here with some significant space to the downside. So from my perspective, something like upside in the euro, upside in gold, those might be the trades that come out of this potential chart. The dollar index isn't something people trade all that much, but you do have things like gold. By the way, silver today, potentially, I haven't had a chance to really get into it too much, but silver is potentially on the weekly here. We've watched this one a lot, and I mean, this is I think getting in an area where people might want to kind of be thinking about it. I mean, this is kind of interesting here. We're on pace here. I don't know. It's pretty interesting. There's different ways to look at it, and I don't want to get too much into something that's not my main focus here, but it is interesting to see the dollar index breaking to the downside, gold and silver being strong, things like that. Euro is the main inverse of this. Long euro would be the opposite of short DXY. All right, now we look at the sector funds of XLB, which are materials. And the steel tariffs had a certain impact here, but I think it's also important to realize is that this is also facing some potential resistance here. This level from late February, the level from, and then the high from late, the low from late Feb, the high from late March. Support, resistance, and then let's see, we're stuck there. But this also does create. I mean, if you are more bullish and you think things are going to end up in a good direction here, this could actually be something here that does turn into more of a positive sort of thing. And I think when you're in a range, you got to just realize that, it hasn't decided what it wants to do. And that's where we are now. There is some potential here for this to become a bullish sort of ascending triangle. But then I've also seen patterns like this happen, and then they just look and then they just die. So I want to just point that out. To me, the key level is the area here between about 87 and 87.5 on the XLB materials ETF. XLC, the communications ETF, also here, it's just kind of in this range. It's kind of pushing the high, but at the same time, things like this can kind of drift and play games and then just drift around. And so I think what's important here is that if the market does want to peak here, this would be potentially a lower weekly high. And if not, there's really no clear sort of opportunity here. I would say that the main thing from my perspective is that there is the potential for it to run toward the highs, but let's take a look on the daily chart because the weekly is not telling us very much. I mean, people want to be looking for it to break much above something more like 102. So this is also just kind of in a range. You can play up and down and up and down. And from my view here, you're seeing it hold above this level from late March, which is potentially positive on the daily. But overall, it's similar to something like the NASDAQ, and it's essentially range bound here, and no real sense that it necessarily has much follow through happening. Now, on the energy ETF, XLE, we had this big OPEC increase. But again, this is something now that is showing signs of actually making this kind of important weekly lower high here. So from my perspective, this is something with energy right here that has potentially, some potential to test back down toward these lows and potentially make new lows on the weekly. But, the thing I think here is that this will also kind of follow the overall, situation where if there's good news out of China, it could probably have an attempted rally that then gets hit with selling. So this is something here where it's economically sensitive enough that it will also kind of, it's waiting. These things are waiting, like the energy, the Russell. These are now in spots where they're weak, but people are waiting. Today, Monday, June 2nd, is not the day, but everything is waiting and sitting. But when you look at this thing on a structural basis, the actual pattern, where we are in the weekly, this is something that is one of the weaker overall charts. I think it's actually I think it's the worst performer on a year-to-date basis as well. Now, financials, XLF, are very similar to communications in my view. They're basically just kind of sitting here, and this could turn into a lower weekly high. It's interesting just to see that it's in this range. There is some sensitivity here in terms of interest rates. If we get more of a vibe of a recession, the financials overall are not as likely to do quite as well. It is interesting, though, to look at some of these stocks like AIG and some of the property and casualty names like Allstate. And from my view here, this is actually where people might see some opportunity. These property and casualty names have been kind of a secret go-to when the market gets less bullish. And I want to point that out. Allstate, Travelers, Chubb, CB. I was looking at a very interesting chart on CB, a kind of high basing pattern. This is a property and casualty name as well. All right, so XLF. XLI is next, the industrial. Now this has some risk of a double top here. This has a real strong rally, and now I think people have to realize that this has a risk of becoming a long-term sort of double top, and it has a potential for breakout, but otherwise it has some potentially significant space to fill to the downside if people get more on that bearish side of things. XLK, very similar to things like the NASDAQ and the communications here, where it's in this range and kind of drifting. The weekly is not giving us much of anything aside from looking at it potentially becoming a lower weekly high if that is what actually happens. But again, we might just be in June and just hitting our head against the wall all month because that is the kind of environment that we could be in. That was the XLK. XLP is in a very similar sort of situation here. And from my view, this is something that has that potential. If the market gets bullish, this could be something that actually drops. And from my view here, it's something that, like the consumer staples don't have very much of anything going on. Now, real estate remains to me a potentially pretty negative area. And I think we have growing sort of risk with commercial real estate and refinancing risk with long-term yields moving higher. So I want to kind of point this one out. This one remains one of the more problematic ones as well, with this downtrend in effect and this resistance from the levels back there in late March. XLRE. XLU, of course, also there is the whole data center nuclear energy sort of buzz, but at the same time, we have interest rate risk. So from my view here, this is something where people really might want to wait for a good weekly closing high above 84. Otherwise, this thing could also just enter into, this could enter into a multi-month period of just consolidating and waiting if yields continue higher. That's XLU. XLV. This is something where people might see some potential for an upward squeeze. There's been a huge amount of negativity in the healthcare XLV with United Healthcare and everything else kind of blowing up. And now a lot of that has happened. We also have a big biotech conference this week that could potentially kind of be a positive for XLV. So I want to point that out. This one might actually have the potential for some squeezing back up toward kind of the highs from April or even potentially higher. This is a non-cyclical thing, and if people want to get and if we start getting real fears about recession and things like that, it could actually be a positive for XLV. XLY, the consumer discretionaries. It's interesting to look at this because this is stuck under their January low. The S&P 500 is stuck above, is sitting above. Look at the S&P. It's above its January low. This is the January low, and it's been support. Now, if you look at XLY, it is stuck under the January low. So I think these guys have retailers in there. They have home builders that have been doing poorly. They have a lot of discretionary stuff, and obviously Tesla. So from my view here, this is one that actually also has more kind of risk kind of in a negative spot. So things like, real estate, things like consumer discretionary, things like small caps, kind of in that potential more of a danger zone. And then things like technology and financials, have more of that sort of spot where if the positive, if worst case scenarios don't play out, they may have kind of cleaner paths to the upside. But one way or another, it's just here potential of a drift in this range, as we highlighted earlier. So those are the main things I wanted to cover. Hope everyone has a great rest of the day. We'll be back on Thursday with market trends. I'll see you then, and take care. Thanks for watching.